Friends, we meet again for another dividend portfolio review, which means it's been 2 weeks since our last video, and we continue to be here as time continues to pass. And there's no better way, or I guess worst way, to be reminded that time passes when you start losing family members over time. I just want to dedicate this video in particular to anyone who has lost a loved one recently. I lost my grandmother, and that'll now be all my grandparents gone from this earth. And if that's not just a reminder to you, to us, that time passes, let it be a reminder that time passes regardless. That's why regardless, if we think about the future, time is going to pass. So through that, plan ahead. Make sure you're financially in a place that you're comfortable. So that way, if you're lucky and the time arrives and you're able to age, you'll be there and you won't have to stress about your funds. And that's why we're here, friends. I know a lot of us think about the future. Maybe I can say all of us do. And if you're a dividend investor, you clearly think about the future. You plan ahead, and you're into that slow and steady approach, that passive way of building wealth over time, leveraging this time that we have to build that financial base, that financial foundation that we'll be proud of, that we'll thank ourselves for when the future comes. But the future isn't promised, and sometimes losing family members is the best way to be reminded that this time continues to tick, and it's up to us what we do with it from now until that last day. But hopefully we all get that extended time on this earth. But friends, as always with these dividend portfolio reviews, I'm going to go into the statistics. 2 weeks ago we went over that monthly dividend portfolio review where I did show you how much I make in dividends. But in these videos, I just choose a topic and we roll with it a little bit more raw, a little bit more podcasty, if you will. So in today's video in particular, before we get into that dividend portfolio review, I'm going to explain 3 steps of what I believe are critical to building that retirement foundation in your early 20s and 30s. And looking into the statistics of this channel, a lot of us actually do fall into that age range. So welcome if you're here, friends. Hopefully you enjoy this one as well. I'm having fun with these as time continues to pass. But as far as 3 steps, friends, to building up this retirement foundation in our early 20s and early 30s, what are some things that I'm doing? What are some tips that I can suggest? I mean, I'm living out these tips in real time myself. I'm only 27 years old. I'm going to be 28 later this year, but I'm living it. I'm not retired. I'm not 50 yet. So this is me systematically over time, following a game plan, adjusting it over time and trying to execute on it, and ultimately seeing what happens. So far, it's been working. I started my dividend portfolio, if you're new here, in the year 2020. I entered the workforce in the year 2019, and we continue to plan for retirement. One of the first things when I personally entered the workforce at the age of 24, or I can even say even before, friends, was how can I retire? I was already thinking about retirement before I even started working in the workforce. And I think that's the right mindset to have. Because if you just enter the workforce, you just make some money, you spend it, you buy that car that you've been wanting for so long in college. Now that you're out of college, you start spending, going to nice restaurants, buying clothes. You start spending and you don't think about the future. Maybe you don't see yourself in the future in terms of retirement age. You think it's way too far in advance. But as we just mentioned, time passes regardless. And if we're all lucky, friends, we will age and we will be later in our 30s, in our 40s, in our 50s, 60s. And the later that you kind of postpone this retirement plan, the less you're going to be happy with your situation, when that time comes. But if you utilize this time, you utilize it when you're younger, you start building this retirement foundation, it'll compound over time, exponentially, over these next couple decades. So that way, when you do reach the age of 50 or 60, you're already a couple decades in, and you're going to thank yourself so much. One of the things that I use to kind of, help me as a guideline is just looking at the people ahead of me, looking at the decisions they made and the outcomes that I see them currently having. And by this, I mean the people that I see ahead of me in their 50s and their 60s. You can tell right around that age, when someone did something well financially or when someone didn't. And if you didn't do anything well and you're already at that age, you're likely so far behind. The outcome is what it will be. It's not like your body at that point is in a youthful state to double down on work, double down on overtime to try to catch up or try to invest in the stock market and, exponentially or compound your money over decades. By that time, it's too late. By that time, you want to rest and relax. You don't want to have to stress about money. So do yourself a favor, friends. Plan that financial retirement foundation today in your early age, and you will thank yourself later. And as far as what I think are 3 tips, I'm going to go over them here. You already see them on the screen, but I'm going to dive into each one at a time here. As far as the one thing that I think is the most important for starting that retirement foundation, I truly believe that you have to start as soon as possible. Like I mentioned, right before I even entered the workforce, I was already thinking about how it is that I can retire. Because you're going to be in this workforce regardless, friends. You could be in it indefinitely. And the reality of the workforce is that it owes you no favors. It's like that worker ant. It's like that worker bee. You're in it until you're no longer useful. As you age, you're no longer really productive. This is the system. It uses you for labor and it gives you the cheese, which is the money that you then need to survive and, hopefully thrive one day. But this is the system. It takes you in when you're youthful and then it spits you out when you're no longer useful. You're no longer productive. Your body has failed you, in your 50s and 60s, sometimes younger, if people have to file disability. But this is the system. So do yourself a favor. If you're currently in the situation where before you enter the workforce, start thinking about retirement. If you just started the workforce, start thinking about retirement. If you've been in the workforce a couple years already, maybe a decade even, start thinking about retirement. It's still not too late. Every day that you start doing this ahead of time, you're going to thank yourself in the future. Maybe starting today, a decade already into the workforce, you can buy yourself a couple years of earlier retirement. There's no lost cause to this. Today is the soonest you can start. So you have to start today, and it will compound. It will exponentially just build upon itself, and you will feel it. Maybe not now, but the benefit will be there. If you are lucky and you age and the time arrives when you're in your 50s or 60s, because like I said, you can tell the people that did it wrong at that age, and then you could tell the people that did it right. They're living a different lifestyle. They're operating on different time and different terms in this life. They go on vacations, they go on trips, they have that boat, they have that car. They live in a lighter way, they're happier. They're not stressed about money. One of the biggest stressors in this life is money, unfortunately. And just imagine that weight, that pressure in your 50s and 60s, feeling like you're behind, feeling like you can't afford what it is you need, and especially what it is that you want. The last thing I'll say on this is, can you imagine being at the age of 60 and 70 and working your whole entire life to just still not be able to get what you want? That is pretty depressing. So don't do that. Do yourself a favor. and start thinking of retirement as soon as possible. And the soonest day is today. And as far as the second thing, friends, set a goal. And through this, part of it is also determining the lifestyle that you wish to have. And through this, you're going to have to find compromise. What I mean by this is, here you are, you started thinking about retirement. Now the next thing is, what type of lifestyle do you want to live? Are you someone who is, materialistic, I guess you can say? Do you want things? Do you want experiences? Do you want money? Does money mean something to you? It doesn't mean something to everybody. Some people are okay, backpacking and going to hostels and, vacationing in this manner, spending the least amount of money as possible. Maybe also not working as hard. Some people aren't super ambitious in their careers or in the workforce. Some people aren't striving to make $100,000 a year or $500,000 a year or $1 million a year. Not everybody is striving for that. Some people are okay just, going to a normal job where they work 8 hours, maybe get paid $20 an hour, and they come home and maybe they have a couple side businesses. Maybe they just enjoy their free time to spend it with friends. But once you kind of decide to start thinking of retirement, you're going to have to start deciding, what type of life do you actually want to live? I know for me, just as an example, when I was in college, I thought about the van life. I thought I wanted to, live in a van and travel and, be okay with, maybe not too much money, but just enough to kind of get around and, invest the rest and, be fine with that. Retire early, maybe a FIRE. But as time went on, I started making money. You can say I got that capitalistic bug. And maybe it's a good thing, maybe it's a bad thing. Everyone has their own opinion. But now I can't see myself living the van life like I used to want to envision it in college. I went to an Airbnb and I got a taste, and then I started going to restaurants, getting money. I got a taste. And I have this vision for myself that in retirement, I want to live a good life. I want to live in a house that I'm proud of. I want to, drive the car that I've always wanted. I want to go on as many vacations as I can and, not super, be on a budget per se, but be able to spend money, get that higher suite if I want it, get that ocean view if I want it, extend the trip if I so desire. Those are the things that I want in retirement. Well, what does that entail for me? It likely entails that I'm going to have to work harder, trying to find ways to increase my income, invest more, retire, and, with a fat FIRE as opposed to just a FIRE that I was thinking about before. These are just all adjustments that, you're going to have to make if this is a lifestyle that you want. Or the opposite of that would be, being okay with less. But that's a conscious choice on your behalf. Maybe you're okay with less in retirement. Maybe you're okay with living just in a normal suburbs and, not that higher substandard. Maybe you're okay with living in the suburbs and you don't want to live in that nicer neighborhood, in that slightly bigger house with the nicer view. It's all perspective. So in this step, friends, the number 2 is set that goal, determine the lifestyle that you want. And in this process, you're going to have to compromise. If you want to live, an above average life in retirement, you want to have that money to spend, you're going to have to compromise. You're going to likely have to work harder as, in your early years, and then you're going to have to invest more. You're going to have to be smarter with it. You're going to have to go out and get it. It's not going to come to you. The other compromise is, if you're okay with less, is that ultimately over these decades, you're going to be planning less. So when the time comes, the outcome that you get will be the one that you get. And maybe there's no going back at that point. So for example, you're okay with, living in just that normal neighborhood in retirement. You're okay with not going on too many vacations and, upgrading the suite. You're going to have to live with that when the time comes. Because when you're in your 50s and 60s and you go to retire, and at that point you want more, it's going to be very difficult. So the compromise is going to actually happen in real time for you as well. So those are just some things to consider as far as the second one that I think is important for building this retirement financial foundation. And the third thing, friends, adjust, add, and pivot as you go along. What you plan today may not likely help you achieve that outcome that you so desire. Oftentimes our plans initially, even though we execute it, even though we do everything in our power, everything in our control, we may still not achieve that outcome. Some things happen in our life and it really does push us down. Oftentimes we will fall, and it just depends on how strong we are at that time, maybe the timing, where we are in our life in that moment, what we're able to withstand in that moment. It may determine ultimately the outcome to our life. I can plan right now everything. You see some of my videos. I plan and I plan and I plan. I plan so easily because I think of the future so much. But reality is, friends, I've already, even at the age of 27, just 3, almost 4 years into the workforce, which isn't very much. I've already adjusted. I've already pivoted. My plan from, the first video I made on here up until now, it has changed already. If you've been following the journey, that's just confirmation. But this is also confirmation that I'm at the age of 27. And if I want to retire at the age of 50 to 52, I can have this plan. But just imagine all the changes that are going to happen between now and then. So growth has to occur at the same time, because you're going to have to adjust, add things, take away things. You're going to have to pivot if you have to make some hard decisions. But that is part of the process. So just let this serve as a reminder that change is inevitable. One of the only guarantees in this life, maybe death, maybe taxes, but another is that change is ongoing. You were changing today. You changed yesterday or a couple years ago from where you are, or from where you were then to now. Change is inevitable. Change is part of the process. And you're going to have to learn to adjust, add, and pivot, and not allow that to take you out. And if it does make you fall, that's okay, friends. But don't stay down for long. That is key. That's why you have to pivot sometimes. And maybe go in a roundabout way just to get to the destination that you want. But that's growth, that's experience. And oftentimes your story can be shared. And if you don't want to learn and make the mistakes yourself, friends, look at the people ahead of you. That's what I always do. Learn from other people. Hear my experience if you're watching these videos. Learn from me as well. The earth, the world, it's full of information. Use it. That's all I really got to say. But as we continue forward, friends, here we are once again in the Jesse's cash flow portfolio. We're still pushing $100 into it every single week, and that remains as the game plan. We just recently moved as well, so that's another thing ongoing in my life. I also became a supervisor and then didn't anymore. That's maybe a story for another day. But, right now I have been spending more money than I wanted to, and again, this is that change. This is that adjusting, that pivoting. When you move, you kind of spend money. We are leasing a new place now, which is bigger and should ultimately increase and enhance our quality of life. So that's a compromise. That's a decision that I made, but I think it will pay dividends, no pun intended, into other aspects and other projects that I want to do, now and into the future, as time continues to tick. But here we are, $67,508.88. That's with a return of 19.26% overall. And this equates to an all-time gain of $6,811.03. And if you look closer, friends, our earned dividends has been more than the market gain for a while, but it looks like our market gain has been catching up. And that's, overall very interesting to me. It kind of feels like we're in stagflation because, my wage hasn't gone up. I don't know about yours, but prices continue to go up and houses aren't really going down as much as I thought they would. And people are still going on trips and vacations and everything is still getting way more expensive. So I don't understand exactly how the economy is still holding up. We all can have our guesses and our, theories, but look at it for what it is. It's interesting, and I'll just kind of leave it there. But my market gain has surpassed my earned dividends, at least for this moment, by $50 or so. The market gain is $3,425, and our earned dividends is nice little cushion, $3,385. And when you're a dividend investor, that is what this is all about. That is what you do this for. So don't you ever forget that. I'll let this serve as a reminder that it is worth it, because you never have to take out chunks of your portfolio like you do with the 401k when it comes time to retire. Your dividend portfolio nest egg, you will always see it. If it's $2 million, it will be $2 million, and you get a dividend on top of it, as opposed to having to sell it for chunks. I mean, for me, that's a better trade-off. But everybody has their own tolerance as to how they want to plan their future out. I mean, clearly, if you're watching this, you're a dividend investor, and you likely agree with me. But before we go down, let's see last week, just because I'm curious. It was a return of 1.8%, which is pretty good. A total gain of $1,187, so not too bad. And if we want to look at the last month, somewhere around 1%, a total gain of $600, almost $700. So not too bad as well. And if we want to go to year to date, this one's a little interesting actually. If you look at the actual graph itself, it's been going up and down, up. And it looks like, it has been feeling like things have been going up once again, which, has me a little worried. I mean, in terms of stagflation, because I know, like I said, my wage hasn't really gone up too much, at least in comparison to everything else around. I mean, everything else is so expensive nowadays. It's insane. But year to date, we're up 2.66% for the portfolio, which equates to a total gain of $1,713. And year to date, we've made $746 of earned dividends. So I will take that. No complaints. And I always say it around this section, but if you're curious to looking at my pie down below, there's always a link in my description box. You can click on it, and it'll show you everything in more detail. Just because if I go into detail, it will be a way longer video, and you could just click on that link on your own time and check it out. It's way easier. I do want to point out here on the upcoming trades, you will see I have 5 buys, and I do have 1 sell. This 1 sell was actually a spinoff from MDU. I think it was Knife River. One thing that I always do with spinoffs, it's just my preference, is I sell them. I just sell them off. I don't really bother to do the research or bother to hold them, because initially it wasn't a stock that I was interested in. It's a spinoff from the stock I was interested in. So in that sense, I just get rid of it. I sell it, and I put that fund, drip it back right into my portfolio. But just to be transparent, that's why this sell is here. And as far as my slices, let's see where we're at. Best performer for now is tech. And I mean, let's just take a look, because I'm curious. Nvidia looks like it's blasting off once again, 174% return, and followed by Apple at 45%. But I mean, a takeoff like this will certainly make that difference. I mean, my value of it's $4,900 right now compared to my Apple, so it's significantly greater. The actual target of 48% is significantly greater than the one right under it, which is around 22% with Apple. So yeah, I mean, Nvidia, it went up and then it went down not too long ago, if I remember. If we go on its all-time chart, I think, it went up and then it kind of came down, and it's been going up ever since, and it recently peaked. I haven't been keeping close tabs on it, so I don't know exactly what the boost off was, but maybe it's AI, maybe it's gaming. If you know, maybe you could share it down in the comments down below. Maybe I'll take the time to look into it following this video. But as far as after tech, I have energy at 104%. I also have consumer discretionary at 51%, and then everything else follows. As far as my red holdings, utilities is down 3%, healthcare, real estate, as expected, and then communications, it's always sluggish. It's actually down 18%. And which one is the culprit? Looks like it's all of them. It's AT&T, Verizon, Comcast, Omnicom, this fossil. is actually up 79%, that's awesome, honestly. That's pretty amazing. It's been carrying the rest of these big boys on its back. So I will take it. But see how interesting this is, friends? AT&T, Verizon, Comcast, I mean, maybe not so much Comcast, but Verizon and AT&T. These are the ones that most people have in communications. And you would be fully in the red. Like your whole sector of communications would be fully in the red, if all you had was these two mainstream holdings. But I have Omnicom, a little bit of an underdog. It's been around for a long time, and it's up 79%. So just for perspective, I mean, you can plan ahead and just be wrong. I mean, who would have seen that coming? I know I didn't, but that's how it works sometimes. And let's just go into our activity section, because we are kind of diving a little deep here in this video. It's a little podcasty. I mean, we can have fun with it. As far as, my deposits here, it is for transparency. $100 deposits, every week, every Friday. And as I mentioned, here's that Knife River Core, spin-off. I got 6 shares of it, and I'm planning to sell it off, so it won't be here anymore. But everything green here is a dividend payout, as you can see. And I continue to get paid dividends, $8, $6, $9. It just continues to, drip and build upon itself and funnel all in the background. $12, $13, $11 by American Tower Core. And, that's what it's all about, friends. That right there. Let me show you a little bit of the data of my portfolio. Once again, I do this, in every video. I try to, at least, for people that are new. So as far as my holdings, if you're curious, I have 51 total holdings. It is a lot, but I knew that from the beginning. It wasn't an accident. It was intentional. And as far as my dividend yield, it's at 3.175%, and my expense ratio is very low. I do like having fun, managing my own portfolio. It is a preference to each and every person. I know there's higher risk when you do it yourself, but for me, there's just more enjoyment. So I'm willing to take that risk. I'm willing to, get some spin-offs and have to deal with it and sell them and maybe do research or not. I'm willing to do that, for the trade-off of the enjoyment of managing my own portfolio. And so far, it's been okay. I mean, I've been showing my dividend portfolio ever since the year 2020, I think in August, when my first video came out. And we've been doing pretty good. As you can see by the all-time charts, I mean, my portfolio has been slow and steady over time. And I'm very proud of it. And hopefully, friends, it could just serve as an example for you. Maybe you're doing, some work on your portfolio as well, and it's just fun to watch somebody else sometimes. I know when I started my dividend portfolio, I was kind of lost, and all I wanted to do was just see other people's portfolios and just kind of compare a little bit, see how I'm doing, in the grand scheme of things. But time is going to continue to tick, friends. I'm going to continue to be here, and I do enjoy making these videos. So I'll see you in another 2 weeks. As time passes, we continue to be a dividend investor, and we continue to funnel into this thing and watch it grow all the way up until our retirement, hopefully an age that we can reach and live comfortably. But as always, friends, I'll be here next time, and I'll see you then. Take care.